Welcome to Transaction Preparedness, analyzing your people, operations, and balance sheet management before the deal. This session is presented by CLA and BMO Harris. Let's meet the panel. Steve Henn, CEO, Ideal Industries. Hunter Powell, CEO, Madsky. Adrian Noor, Transaction Advisory Manager, CLA. And the moderator today is Jennifer Johnson, VP, Corporate Advisory Sessions, BMO Harris. Jennifer, the virtual stage is yours.
Good afternoon, and thank you everyone for joining today. I'm Jennifer Johnson. I am a Vice President at BMO Harris. I'm in our Corporate Advisory practice. Today, we've prepared a great panel for you on transaction preparedness. Want to get right into content, but before we do, want to give each of the panelists an opportunity to introduce themselves. So Steve, can you kick us off?
I certainly can. My name is Steve Henn. I'm currently the CEO of Ideal Industries, which is a mid-market family-owned industrial group. And Ideal's completed a number of transactions on the buy side over the past 4 years, both domestic and international, and we're currently working on a couple of distressed divestitures. Previous to that, I spent 29 years at ITW, which many in the Chicago area may know as a big multinational industrial conglomerate, and participated in numerous buy-side transactions, along with a few divestitures towards the end of my career there.
Adrian, can you go ahead?
Sure. My name is Adrian Noor. I'm a manager in the Deal Services Group at CLA, sitting in our Chicago office. I've been with the firm for over 9 years now. Spent the first 4 of those years working in assurance and tax, and then switched over to Deal Services about 4 or 5 years ago. CLA is a little unique. We are the only top 10 firm who works with privately held businesses, so we don't focus on any SEC work. We're really focused on developing relationships with the business owners and entrepreneurs like yourselves. So our Deal Services Group at CLA, we do both buy-side and sell-side diligence and support. About 60% of that is buy-side and 40% of that is sell-side.
And Hunter, do you want to close it out?
Sure. Yeah. Adrian's been great to work with, so I'll give her a plug. She just finished working with us on the deal. So I'm Hunter Powell. As of about 48 hours ago, I'm the CEO of a firm that's called Madsky and Code Blue. We've just merged, so we have a really funky name. I came out of college and did 3 years of sell-side M&A, got to see a great deal market in 05 to 08 at Harris Williams and Company, and then jumped into real estate private equity during the downturn, which is about the worst time ever to be in real estate private equity, more or less contaminated property, which is where I was playing. So I learned a lot about what not to do in those couple of years, and then spent about 10 years at a family investment arm of a $2 billion manufacturing company in St. Louis called Barry Wehmiller. And then about a year and 2 days ago, I left and went out on my own and bought a business called Madsky, which we've since just merged into a business called Code Blue. So lots of deal activity and history, and excited to be here.
Well, Hunter, I think that's a great transition. Sounds like it's been an exciting time for you. So in the interest of getting into content, maybe you can share a little bit more about how the merger's gone and what you've done to really prepare and drive the ideal outcome. And, you know, reflecting back on it, were there things you might have done differently to even further improve the process?
Yeah, it's been a hell of a year. I appreciate the fact that you gave me this question ahead of time, because I put a lot of thought into it, and I've done a lot of thinking about this because we've done 2 sales literally 1 year and 1 day apart for tax reasons. But, you know, in terms of driving a successful sale, I think a couple of things that came to mind here for me. One, especially as a private business owner, you got to understand that you can create the marketplace for your business. You can ID the partners you want. You can attract them and go out and source them yourselves. And then you can create that market because a little bit of competition is always good in a deal without necessarily going and banking yourself or doing a full-on transaction with someone like Harris Williams in an auction process. So I'd say, well, first and foremost, to be successful, ID who you want to partner with. I picked out our partner, which is Aquiline Capital Partners. They're a top-tier insurance investing business. They just exited a big similar service business to the one that we have, and really brought them along and brought an add-on and a merger along with Madsky to bring this $115 million business to be. So control your destiny. Take advantage of that. I would say when you're thinking about getting ready for a sale, look out at your forecast and pick a time when you can perform. Surprises are never good in processes. Performance is always very helpful for getting through bumps in the road, which inevitably happen. And if you're performing, that just always makes things go smoother. I would say the last two things in terms of what you can do to be successful is be transparent. Again, I think surprises kill deals. They don't make deals. I took a very, very upfront approach with both my board, my investors, and with Aqualign as we went through this. And quite frankly, we had a bunch of surprises, but I prepared them for them. And so we got through what was really a bumpy deal, but came out on the better in the end. And then lastly, I would say insulate your team. Performance is so critical. If your team gets dragged into the rumor mill, the anxiety, the distraction of due diligence, that doesn't help your business sell itself. And at the end of the day, the businesses and the clients and the results are what sell. So, in terms of being successful, just the last thing I'd say, and I'd reiterate, take control of your destiny. There's enough private equity firms out there. They are differentiated and they do specialize. You can go out there and find the right strategic or the private equity firm of your choice. Jennifer, if I have a couple more minutes in terms of what I do differently, certainly learned some things here. When I was looking at leaving my family investment arm and wanted to get closer to the action, I'll call a spade a spade. I got emotional about the deal that I went to buy. I got backed into a corner, quit my job, and really had all my eggs in one basket. And I think in hindsight's 2020, looking back at the quality of earnings report that I got done, or looking at some of the diligence red flags that I did not push on hard enough, I was not in the best, strongest position to do that. So great learning opportunity. On the quality of earnings side, I did not do my quality of earnings with CLA, so this is not a reflection on Adrian and the team. I've loved working with them, but I would say you really got to put the time into the details of that quality of earnings. You got to go in depth. If you're going to do it at all, do it almost like an audit. You need cash flow testing. You need to make sure the balance sheet accounts are really, really tight. I had $4 to $5 million of financial impairments in a small business coming out of a business that had been audited and had a QofE done. That should not happen. And I would say that, again, if you're going to spend the money, get into the weeds and really drive that process. In terms of other things just to do differently, if there's been a systems integration and it hasn't gone great, prepare for the worst. It's only going to be worse than you might think. And I've learned that the hard way. And lastly, I guess I'd say meet as many team members as you can. Owner operators are historically going to be a little bit narrower, focused on the bottom line, and not give you a business that's invested with capacity for long-term growth and a bunch of expansions. It's typically going to be pretty tight. So you really want to get the true story, not only from that owner operator that you may be buying or partnering with, but you also want to meet as many team members as you can. So hopefully that helped.
Thanks, Hunter. That was a very insightful answer and particularly helpful given the deal is so fresh. With that, I want to pass it over to Steve. I know your time at Ideal has been more focused on the divestiture side, but both organizations you've worked for have certainly been acquisitive. So would love to hear a little bit more about what have the critical elements of your M&A strategy been and what's differed between the two organizations.
So I would say that both organizations have some similarities and some differences. The similarities being that both were looking to create an M&A strategy around diversification. So ITW is set up in segments. They wanted to diversify their portfolio so they never had everything in an up season, down season, and they could balance them out. Ideal was more a diversification play for the family's perspective. So that, it's a 100-year-old business, has a core business that's been very successfully the entire time. But as the family continued to grow, they wanted to diversify away from a single industry. So they looked at it from a couple of different perspectives. I think the second side of it is around accelerating growth. So in the beginning, ITW was acquiring to acquire, just make businesses better. They could be very profitable at it. But as time went on, they took a much narrower focus and said, how can I use an M&A strategy to accelerate my core growth, whether it's geography, whether it's product lines? And the tighter they got on that strategy, the more successful the acquisitions were. And I've seen that as I've moved to Ideal. Their strategy as they expanded was to create, more legs on a stool, to say. So instead of just being in electrical, they wanted electrical and tools. But the further away they got from their core, the less success they had in the acquisitions. So, from my perspective, when I'm looking at the acquisitions, it's how can you stay as close to the core as you can while still creating some diversity in the opportunities that are out there. And it's critical, because the more you know about the industry, the less surprises you will have in the marketplace, as you ran into, Hunter. I think it's, you can leverage your knowledge, you can leverage your brand, you can leverage the information about those industries, and come to a much better conclusion on an acquisition. I think it's critical that you really know where you want to play and focus there. If you think about success and not success, again, I would say that the larger organization, so ITW could go, large acquisitions or small acquisitions, they had the staff and the capacity to be able to take those on. As a mid-market company, we've been much more successful at Ideal with smaller tuck-in type acquisitions versus going after the big Goliath that really stretched your resources and was much more difficult to get done from an integration standpoint. And you don't know what you don't know when you get into the middle of a deal, and the bigger, the more complex, the harder it is for a smaller mid-market company.
Thanks, Steve. That's particularly helpful. Adrian, I think it'll be really interesting now to hear it more from the service provider's perspective. Clearly, there's a lot that goes into having a successful M&A strategy, whether you're on the buy side or the sell side. There's a lot of things that are similar across both, but would just be curious, based on what Hunter and what Steve shared, is there anything that's in your typical advice that they maybe didn't touch on that you're having when you're touching base with your clients of things they should be doing in order to be successful?
So I don't know if I kind of want to build on really what Hunter and Steve both said. I think they both made really great points that are important, that we try to have conversations on both the sell side and the buy side with our clients. I know Hunter mentioned, IDing who that partner is. And we tell our clients to think about this too, what do you want this to look like? Do you want to exit the business? Do you want to stay in the business? What does that look like? Do you want to still run the day-to-day? It's important to have these conversations early on so that you can really get a good handle on what you're looking for. And then another good point, I think, was the transparency piece, identifying those issues up front that you may have. These middle market size target companies are going to have some issues occasionally. And so addressing those up front and being fully transparent is huge. And it will make, I don't think the fact that there are going to be issues will scare anybody away, but addressing those head on is what's really important and what we try to get our clients to do. And then I know Steve mentioned too, encouraging or, having a market strategy is huge. We're trying to get our clients, especially on the buy side, to engage us early on in those pre-LOI discussions and just making sure we can help them identify risk areas and if there's an industry that they're maybe uncomfortable in, and getting them more comfortable with it, in that pre-LOI stage.
Hey, can I make one comment to that?
Right.
Because I think those are really good points. In the COVID time, it's much harder to build relationships right now. And so every transaction at a point will require grace from somebody, because something will go wrong. And so I think even more so transparency in this environment where you're not across the table, you're not in the same room, you don't break bread together. Man, to me, it's just that goodwill is so much harder to build. So keeping it there and protecting it is that much more important.
I think that's a great transition, and something that I want to explore a little bit more is understanding how, the odd year that 2020's been and the COVID environment, not being able to be directly in front of the companies that you're potentially thinking about acquiring has impacted the process. And then on top of that, the pending election, have you found that there's more diligence, more third-party reports? Hunter, would just be curious to hear first from you of what you've been seeing.
Endless phone calls, just endless phone calls. A couple things. So first off, it's an interesting time because, when this all went down, the debt markets really kind of froze. So the buyers that are out there are smaller now. So if you have what I think Steve really intelligently stated, a core strategy that's well-defined, you should have a better opportunity at getting a deal done right now because fewer people should be calling your targets and your competitors and the people that you want to buy. Will it be harder? Yeah. Will you differentiate yourself with your persistence and, insisting on trying to get in front of someone? Absolutely. So I think it's been interesting for us. We got partnered with a great private equity firm that had just raised their newest fund. They were fine to close with equity and then do a debt deal later for speed, which I think meant a lot to us. And I would say anyone who's going to entertain being acquired right now ought to put that skunk on the table real quick. Is this going to require financing? That's a critical question that in the past, I think has been something everybody had. Now it's a little bit different. And what is that going to look like, right? You don't want to get over equitized on the front end just to then get a recap out and have your ownership percentage be lower than you want it. So something to be wary of. A lot of people, us included, got a PPP loan. I thought that might be a hassle. It's turned out not to be for us. Our bank was KeyBank. They were fantastic. Change of control waivers and all that, I think, is only getting simpler by the day as the government provides updated guidance on stuff like that. But having an escrow that is run by the bank who gave you the PPP is going to be required. So that was actually a little bit of a last minute trigger for us to get away from a traditional escrow provider into KeyBank doing the whole kit and caboodle because they required it. And yeah, I think, listen, the less intangible diligence is a real big thing. I think it goes even further back to Steve's point. If you've got a core strategy and you're tight on it, you're therefore less emotional about what you do because you know it fits, then it keeps you probably better within the boundaries. But you can't go meet people. You can't go get to know someone in a softer setting, which for me, with the business we merged here in Springfield, Ohio, was so critical. Now, thankfully, I was able to do in-person meetings. But for a lot of people, you're not. And so prepare for more phone calls, prepare to repeat stuff more because you got to tell more advisors and you just can't get in a room and kind of get to know each other. So thinking thoughtfully about how you price that in, right? I mean, the intangibles is what gets you that goodwill and that grace and threw a lot of that on the deal and then on the other side of the deal. So it's a tough variable. I don't really know how to caveat it, Jennifer, but that's what I've seen.
Steve, what about from your end? You said you've been working through divestitures. Have you seen, similar changes as you've gone through those processes? Anything different from Hunter?
It's been very similar in the fact that I think there's less people involved in the deals that are out there, even when you put a book out. But the people that are responding are much more appetite driven to get something done. But again, most people aren't traveling. We just got an LOI signed today on a divestiture, and one of the 5 teams was able to travel in. It was a strategic buyer. They said, we don't care. Tell us what your protocols are. We want to see the facility. We want to meet the team. The others didn't. And with the ones that didn't, you were, like Hunter said, you had to be very flexible and very patient with the amount of video calls that they wanted to have, because you can't spend 2 straight days with a diligence team. You're doing it in 2-hour chunks on a video call. And so it's significantly different. You can't expect somebody to spend 8 hours with your management team on a call because it's just not the same. So you break it up into smaller pieces. You get them as much data as they can absorb. Then you kind of wait for them to come back and ask more and more and more. And they tended to have asked more and more and more, where you could have gotten that done much quicker across the table, kind of looking each other eye to eye. So I think it's been quite different, but the deals can get done. There's a lot of money out there. And people with the right strategy. So our buyer, they had a very limited strategy. We fit. They're paying cash and we'll move on. So it's worked out.
So Adrian, having to be the one who's doing the diligence, have you been able to rely on things being done via video? That's a completely different ball game if you can't be in front of a client. How has it impacted CLA from that perspective?
Yeah, I mean, we've definitely had to get more creative, to Steve's point, with how we see operations, how conversations with management, and even, a lot of times our clients want us to assess management's capabilities, and that's hard to do, through Teams or Zoom, or, when you're not in the same room as them and having kind of those 2 days of discussions. So we've had to get creative there. There have been instances that we have gone out when it's absolutely necessary. And really we're taking a very customized approach to each target company because everyone has been impacted differently. Some businesses had a complete halt. Some businesses had a pickup even on top line revenue. And we've had to analyze it from the top line, the expense side. It really has been unique for everybody. And so we're just trying to take each target company case by case and find the best way to present what we think is normalized EBITDA. And in certain cases, I'm sure this may or may not be a surprise, but we've even looked at pre-COVID normalized EBITDA, and we have kind of an adjusted EBITDA and an EBITDA if COVID hadn't happened, and that's been unique. So it's been interesting, and as long as I think the diligence report is articulating what's happening here, we kind of get through it, but it's been very unique.
I think there's nothing a banker likes less than opening up some form of diligence to find 4 separate EBITDAs, but yeah, completely understand it. And maybe transitioning the conversation a little bit back more to normal times, we're focusing a lot on transaction preparedness. And I think there's a lot that you certainly can do to improve the outcome, but there's also the right balance act of there's potentially too much that you can do that can lead you to miss out on a deal. So Hunter, I'm curious, as you've gone through your M&A history, have you looked back at things where you think, maybe we wouldn't have won that deal if we hadn't gotten as in the weeds as we did this time, or if there have been other things that have maybe led you to walk away when it would have been a good purchase?
Yeah, I mean, I think, again, to go back to Steve, it's a bunch about strategy. Where do you want to go? And you got to make sure you want to do acquisitions in the first place. They're distracting as all hell. They're hard to get done, and most of them don't go well, right? So you got to be really strategic about why you want to do M&A, and that'll help you then focus in and get the right deals done. I would tell you, we suffered at that in my last company. We kind of had somebody, me included, at the kind of investment arm, and somebody in corp dev, that we had irons in all fires, but we missed the deal right underneath our nose in the most strategic sector that we wanted to get into, and I still don't know how we didn't get a look at it. And it happened twice in 2 years. So that's just, to me, where if you try to cast a wide variety and, we want to go do acquisitions, you're probably not going to get all the right acquisitions done. A couple other thoughts that I think are really critical is you can't time deals. So trying to time the market, I think you either need to commit to it and go and accept that you're going to kind of have some sacrifices to be made to get the right deals done when they come up, or plan on not getting all the deals you want. We're actually looking at a deal right now. We just merged our 2 companies 48 hours ago. Another really interesting thing that Steve may comment on after I make this comment is, when you look at valuing a business, what are you willing to pay for? We lost out on 5 acquisitions in my old firm because one firm paid 1 turn more on every deal. And they were willing to pay for value that they created via synergies, just a little bit of it, and we weren't. And so if it's highly strategic to your business, that's a call you got to make, and you got to know where you're going to stand. But that is a differentiator in the market. And then just 2 other quick things. I don't mean to take up too much time, but I'll tell you, one of the things I would encourage everybody on this call to do is build relationships left and right. My summer intern buddy is the guy who got me my loan to buy Mad Sky, and he was the only guy in the market that wouldn't give me a loan with a personal guarantee. You just never know who's going to be in the deal market and who's going to benefit you. So you always ought to be making connections, and then you got to find advisors you trust.
Steve, I think one of the things you and I touched on a little bit offline as we were talking about different fundamentals and thinking through valuation was the way a firm arrives at the value. So I'd be curious, as you think about your time at both firms and what you've typically seen in terms of how firms use weighted average cost of capital. Has that been something that has led them to miss out on opportunities because potentially it maybe leads them to come to the wrong conclusion on what they could and couldn't afford?
Well, I think that really depends on the company. So I've worked, the two firms that I've been with have totally different philosophies around it. ITW is leveraged appropriately. Their cost of capital is low. They had a formula. They never really wanted to pay more than a certain multiple unless there was true strategic value that would help the business expand their organic growth. And if that was the case, they would look at it slightly differently. With a privately held firm, and Ideal up until recently is a family held firm that had virtually no debt. So they also ran with a model and a kind of return on invested capital trigger. But when you're all equity financing, your return requirements are higher because your cost of capital is higher. And unless you're willing to really take a look at that from a strategic standpoint, you are liable to miss out on a lot of deals that make a tremendous amount of sense for the company. And so I think it also goes back to what I said earlier, and that is if you've got a really tight M&A strategy, then you can look at your return requirement. And you could go to what Adrian said about looking at different EBITDA modeling based on what different costs of capital are if you were leveraged appropriately versus being debt-free, and then make a better decision as to the risk profile that goes with it and whether you're willing to pay a higher price or not. Because paying a higher price is all about the risk factor. And the tighter your strategy, the less risk. You can reduce the risk one way versus the other.
Absolutely. I think that's a great point. It's way too easy to get into a deal and bank on all 5 to 6 things that you've identified going right. And so often that's just not the case. And so having a good framework of what's realistic versus what isn't. And maybe the last question, and I think it's an interesting one, speaking particularly to privately held businesses, but even in the PE space, there's a lot of different constituents and a lot of different interests. Adrian, I'm curious, as you work with your clients, how often do you find that they have an M&A strategy that's addressing both the objectives of management as well as the family, and that there's strong alignment between the two?
Yeah, I see a wide range of them getting this right sometimes, and then sometimes we're just not getting it right. Again, I think this came up earlier in our conversations, but the earlier that you're talking about this, the better off you're going to be. And just identifying those partners that you want throughout the process can help accomplish both the corporate goals, the M&A strategy, and the personal goals. I know, at CLA, we've got people who are going to help you with the tax structuring, the diligence, wealth advisory, the personal tax. So it's kind of a one-stop shop where you're making sure you're getting all of those, both corporate and personal goals accomplished.
Hey, can I make a comment here? Because I think this is really important. As you look at buying companies and or selling them, and you think about the keys to success, so much of it lies in the people. And most people haven't been on the front lines of doing due diligence. And then on the other side of having to learn and fight through all that change, you got to want to travel. You got to want to work extra. You got to have incentives and career, aspirations that align there. And one of the things I think that Steve would probably reiterate along that I've seen in my career is if you just assume that everyone wants to grow and everyone wants to do more, that's not a firm foundation. That's not something you can build off of and be confident in front of your investment committee. I can do this deal because these 5 people who are needed are going to come through. And that's where the transparency internally to your own team and having those open and honest dialogues, it's scary to do if you're an owner of a business because you don't want to risk the rumor mill, but it's also scary to bank on the outcome if you haven't had those conversations.
Steve, anything else you'd add on balancing the various objectives and planning for it?
I think I would certainly reiterate what Hunter said. The team is critical. And when you're working for a privately held group, it's not only the management team that's really got to own it. You have to act like you are the owner when you go in, because you're all in. You can't just do it part way. But you also have to have your investors, your constituents, your shareholders. With us, it's the family. They have to be fully aligned in exactly what you're doing and where you're going, because in the end, it's their money. And you are the steward of their assets, and you need to utilize them appropriately and make sure you get it right. And without that backing, there's a lot more work to get done after the fact than there should be. So it's nice to go into it up front, knowing that everybody's aligned, so that you can consummate a deal and move it forward the way you want.
I think that's a great way to close things out. And then I want to thank everyone for joining the discussion today. At this point, we're going to move into the Q&A session. So thanks again, everyone. Good afternoon, everyone, and welcome to the live Q&A session. We'll go ahead and get started. We'll spend the next 10 minutes talking about a few of the questions that came up during the conversation amongst the 4 of us. So I'll start off with our first question for Hunter. Can you share some factors that you commonly see that come up maybe right after diligence, right before close, that have potentially led to a delay or potentially even led the transaction not to close?
Yeah, I think the 2 that come to mind here are just employment agreement terms and or critical economic terms with key leaders. If you don't have those kind of negotiated and ironed out ahead of time, that can throw things into a bit of a pickle. And then just general legal document issues. So whether it's a lease or it's a contract that's longer than someone might have expected, it depends on how deep the due diligence providers are getting and how quickly they get into that stuff. And sometimes how quickly the sellers upload it, right? So knowing where you really want to focus for watch items in due diligence, especially in legal, to get those docs outlined and up on data sites and reviewed, discussed, and addressed sooner than later. I know just on the deal we just closed, there was a consulting agreement that popped in 2 days before close. That was a $250,000 issue no one knew about. So we worked through it, but those are a couple areas where you can see bumps.
Got it. Adrian or Steve, do you have anything else to add to that?
Yeah, just to add to what Hunter was saying, I think, a lot of times if you don't address that like tax structuring piece or even just your working capital target methodology early on, that can cause a lot of back and forth at the very end of the engagement. So it's almost better to really cover those pieces during the diligence process. And then, that way when you're getting near the close date, you're not getting hung up on what's included, what's not included, or anything related to the tax or the working capital piece.
Yeah, I would agree with what both Hunter and Adrian said. The more you get buttoned up front, the less you have to deal with at the back end. And the more people understand, the simpler it goes. And hope there's always going to be surprises. So you're just trying to minimize the amount of surprises at the end.
Yeah, based on sophistication of seller, I think Adrian's point on purchase price allocation and taxes stuff, that can be a hot button issue if someone's really keen on taxes and or if they're really sophisticated, they're going to want to agree on that sooner than later. And quite frankly, that can prevent headaches on the back end. We had that with one of our deals we did a year ago. So getting aligned on that, getting it all ironed out is good.
Thanks for that. Speaking to today's environment, clearly things are a little bit different. As you guys have gone through the transactions that you have, do you think that evaluating, the day-to-day financial needs and what you're looking at when you're doing diligence has significantly changed, or are there things that people should be aware of?
I'll jump in. We just looked at a deal up in Canada, a $4 million EBITDA business that really we felt had $500,000 of bump from COVID related reductions in expenses that would come back in year 2, year 3, whenever we're out of this mess. So I think that's the only thing I'd say for evaluating day-to-day financial spend is you just can't get locked up in too much of a short-term view. Otherwise, you might miss longer-term spikes that will come back on spend. I would also say that, it's really tough to get to how tightly someone's run a business, and even more reason to get into the next level of leadership beyond maybe a founder owner and have open dialogues about where system gaps are, what hasn't been invested in, has anyone ever been on a hiring freeze? I've just run into a couple of those things recently.
I would agree that broader perspective is important. I think Adrian said it in the roundtable video, in that it's really around understanding what the EBITDA levels are and modeling them multiple different ways, because COVID's made everything different. We're doing budgeting processes right now for all of our businesses, and we have to ask those same questions, but you have to ask them on a deal. And that is, what expenses are you not spending today that should be part of your normal business going forward whenever normal happens?
Yeah, and that's all the way from self-funded medical, right, Steve, to travel,
everything,
to 401k if you suspended it. I mean, there's a lot to dig there.
Do you find that that's causing things to take quite a bit longer than they have before? Or how do you find the right balance of making sure that you're diligent about it, but not spending too much time?
I didn't see any time added to our deals or our due diligence processes. It's just another level of questioning and consideration. What you want to do is make sure you're thinking about it on the front end, because if you get a deal ironed out and then you realize you didn't think about that on the front end and you got to retrade the structure, that's not going to go well.
I think that's a great point. And maybe we'll transition into our third question. So, depending on where you are in a company's life cycle, you definitely have different skill sets that are necessary in order to help the organization achieve its strategic growth plan. So, as you think about the various companies that you've worked for over time, how have you really assessed whether or not you had the right management team, the right ownership, and taking it a step further to the extent that it requires replacing anyone such as a founder? Do you have strategies that were more effective in approaching that type of transition? Steve, maybe I'll have you start with that one.
Yeah, I think as I'll talk about it from two different perspectives. As companies mature, their strategies, even around M&A, tend to mature also. So in the beginning, you may have a strategy to just go out and do some deals. They'll tend to be smaller. They'll tend to be done by lower level management teams because they may fit with their divisions and or businesses. And again, as you get bigger or more mature, you're looking for different types of strategic acquisitions that may require a bigger skill set and or broader strategic thinking. So that skill set would need to step up. I watched ITW go through the process of small deals to bigger deals that were more strategic, that would drive more organic growth and or geographic growth, and different people ended up doing them. On where I'm at now at Ideal, I think when you're looking at the different strategies around M&A and what you need to do, you need to have alignment with the founders and owners. You're not necessarily relying on them to be part of that, as long as they're aligned with the strategic direction that you're going. And having I think we said it in the roundtable, we're all about a very tight M&A strategy. And if you're aligned with the owners, shareholders, founders on that strategy, then the the pipeline and the acquisition program becomes much simpler from a target and size standpoint and skill set need standpoint. But I think the bigger and more mature you get, the higher level the strategy and strategic M&A work needs to move to.
Perfect. Well, I think we're at time, but certainly want to continue the dialogue. So at this point, we'll wrap up live Q&A and we'll move into the post session at this point. Thanks, everyone.
Okay. Thank you.